Hello everyone, welcome to the channel where we provide you with that financial education and information. Now in today's video, what I want to do for you is do a side-by-side comparison between a bank and a high cash value life insurance policy. All right. Now I want to do that comparison with 7 key categories here. And oftentimes what I see is a lot of people make the big mistake of comparing a cash value life insurance policy with investing in the market. It's really no comparison. You can't compare the two at all. Investing in the market could actually give you a very, very, very high return, much higher return than a life insurance policy. You also could lose a lot of money there as well, right? And there's taxes involved. It's high risk. It's really two separate products for separate purposes. So they're really not to be compared at all. What you should compare a high cash value life insurance policy is with a bank, because it's a safe, secure place to store your working capital or store your cash, where when you want to use it later on, you have access to it and you can use it for other investments or other ventures or whatever you want to do. So it's a safe place to really keep your money so it grows and you don't have to worry about losing it, right? So it's to be compared with a bank. So let's start with the comparison here. The first thing you should look at is liquidity. Liquidity is the main thing, because remember, this is where you want to store your cash safely, right? So in case of any emergency or whatever issue that may come up, you want to be able to access your cash fast, right? So in terms of liquidity, usually in the bank, it's liquid, so it gets a check there. In a high cash value life insurance, liquidity is a major thing. You can access it whenever you want, for whatever you want, for whatever reason, without question. You have the money there, you can access the money. So that gets a check as well. Now, I will say this with a bank, they passed a law somewhere in 2008 or 2009 where if a bank get into a financial situation, like if we have a recession and they're in tough times, they can legally hold your money for some time until they get back on their feet. That law was passed for financial services because of that recession we had back then, where the banks failed, and it's for those financial industries where they're deemed too big to fail, so you can't let them fail. So if they need to hold your money, they can. So but generally speaking, the bank is liquid. You can get your money whatever you want, and if it's high cash, all you have to do is call up the bank and let them know and plan for that high dollar amount. So generally speaking, liquid. Safety, very safe in the bank, right? It's not invested in anything. Your bank, your money is pretty safe. It's FDIC insured up to $250,000. So that's the only stipulation. So I'm gonna give that 1 check here, and I'm gonna give this 2 check, because there's no limitation as to how much is secured here. If you have $1 million there, it's $1 million that's secure. Whereas they would only insure up to $250,000 here. So generally speaking, your money is safe in the bank, but they do only insure up to $250,000, FDIC. Okay, rate of return is next. I'm going to give this one here, the bank, an X for that. They don't have good rate of return. Here, good rate of return, because what are the banks giving you? 1% maybe less, right? Here you can earn 5% or better, right? 1% or less, 5% or better, right? As a matter of fact, the banks put their tier 1 assets, their liquid cash that they want to have access to, their safe cash, in insurance companies. So you should do the same and do what they're doing. Instead of putting it in the bank, they're putting that money over here, right? So yeah, rate of return very lousy in the bank. It's actually less than inflation. Inflation is what, 3% it's been averaging, and if you're getting 1%, you're actually losing money, right? So That's that. Tax advantage. I'm going to give this also an X there because any interest, no matter how little it is, from that 1%, any interest you earn here, it's taxable. You're going to get a tax statement and you have to pay taxes on the interest that's earned here. Over here, I'm going to give it actually 3 checks. You grow your money tax-free as long as you do it right and you follow the IRS guidelines. You grow your money tax-free, you access it tax-free, and you transfer it to your beneficiary tax-free. Okay, so far cash value is winning, right? Leverage with a bank. I wouldn't give it a check there because you can put your money in the bank, but that doesn't necessarily mean you have your leverage. There are people who put their money in the bank and they still can't get a loan from the bank. You still have to go through that application process. You have to meet certain credit requirements, have certain credit score and all that. So I'm not going to give, I'm going to give it a wrong there, an X. Because you don't really have that much leverage. The bank has all the power. You don't really have the leverage. You know, they determine the terms, what you can do from what you can't do. Even if you have your money there, they could tell you that we're not going to give you a loan. So not much leverage there. Here you have a lot of leverage because as long as you have cash in your cash value life insurance policy, you can borrow against it whenever you want, at whatever you want, for whatever you want. So you have extreme leverage and control over here. Next, retirement income. Again, I'm not going to give this anything but an X there. And the reason being is for inflation purposes. If the whole purpose of having retirement income is to have enough to last. If you have your money saving in the bank, most likely you're going to, not even most likely, for sure, you're going to have less because remember, if inflation is outpacing the interest you're earning there, then your dollars is going to be worth a lot less when you're ready for it, retirement. So that's not a good vehicle or a good place for retirement income. Here, it outpaced inflation. Also, you have it structured where you can borrow against your policy and it continues to earn interest. Not like here. Here, when you pull money from here, the money is going down. Not here. You're borrowing against it and it continues to earn interest on whatever you have in there. And when you die, there's going to be money left over. Wealth transfer. Wealth transfer, because of inflation, less money. The wealth transfer, your money, your dollars is worth less. I'll give this a check here because in life insurance, in cash value life insurance, whatever you put in, you always get a lot more than you put in. So whatever money you put in as premium in your policy, your death benefit is going to be a lot more. You don't have that over here. Whatever you put in, plus the little tiny interest you're getting, is what you have. And remember, inflation and taxes is killing that little that you earn over here. Not the case over here. Whatever you put in, you're getting a lot much more in death benefit, which will be transferred to your heirs to go and do what they need. So I hope that makes sense to you guys. I hope you realize that a cash value life insurance policy is where you should really store your cash instead of saving it in a bank. So my question to you is, if you don't have one, what are you waiting for? Why continue to put your money in the bank when you have this option that shows that it's a lot better than the bank? And the bank themselves is putting their money there. So why do you continue to put your money in the bank? If you have any questions, please leave it in the comments. Also, if you want to get a consultation, I'll leave the link there for you. Until next time. Also, if you haven't subscribed for the channel, don't know what you're waiting for, make sure you hit the subscribe button and hit the notification bell so whenever that I release a video, you're one of the first to be notified. Until next time, see you soon.